Yeah, and it seems like, the market has definitely been reconditioned, at least for the time being, right? So, I mean, we've seen the market, whether it's, some of these growth stocks or even the S&P 500, the Nasdaq, just shooting up in the month of January. So, you alluded to like a credit event down the line. Which will kind of make you, I guess, both bullish for the time being and then bearish for when that happens. So, describe a little bit of what you mean by the credit event, and I guess I don't want to say like, get your crystal ball out and call your shot like Babe Ruth, but if you have some sort of a timing event of when you think that may happen, feel free to dive into that as well.
Okay, so this is where I go back to past matters more than prediction. Okay, so last year was, everyone knows, one of the worst years in history for bonds. But it wasn't a bad year for bonds because of credit risk, because of repricing of default risk. It was a bad year because of duration. So you had something very unusual in the way the bond market behaved. It wasn't due to credit spread widening. It was because the entire bond market shifted. Okay. A lot of loans were taken out post-COVID at very low rates, which matured back then in 3 to 4 years. So there's a lot of loans on the corporate bond side that are maturing in 2024. This is fact. Most crises are refinancing crises, right? It's ultimately about a debt wall that gets hit, and you have to roll over that debt. And we all know there's a lot of zombie companies, meaning companies that cannot afford higher interest expense, that were kept alive because of low rates. So you have this tremendous amount of debt that has to be rolled over next year. On that rollover, default risk should rise, meaning you should see credit spreads widen, which is what you see in a recession, which is what you see in a bear market, right? Suddenly investors say, you know what, this very highly levered issuer, I need to get more money because there's a risk that I'm not going to get my money back. That's where the spreads widen. The thing is, if all that rolls over, or if a good chunk of that rolls over in 2024, the stock market and the bond market would see it in 2023. So the stock market would typically see these kind of things 9, 12 months out. So it seems very plausible to me that you have this melt up scenario. You suck in more bulls, the bears capitulate, and then maybe in the sell may go away period, because sometimes the simplest answer is the right one. That becomes where you might have the first signs of risk off conditions, like real risk off conditions, where you might have credit spreads blow out, you have a repricing of default risk, and then the market starts telling the Fed, you better cool it with higher rates, right? I think that's ends up being the sequence. Now, if I'm right on that, selfishly, that's exactly what I need, right? Because all my funds rely on treasuries to be the safe haven, to be the flight to safety trade. So if you get a spread blowout, I think we'll look back on 2022 and 2023 and say they were both terrible years for bonds. But just 2022 was duration risk, and then 2023 is credit risk. And if that's the case, then treasuries should go back to their historical flight to safety dynamic, which is what failed last year and so badly hit my own strategies.